Good morning, Amitji.
How are you?
Good. Welcome, Bian. And I think seeing John also here. Hi, John.
Happy to be here.
Hello.
Hello, everyone.
Hi, Joan. Hi, everyone. Hi, Bian. Hello, sir.
Hello.
So we
I
are
think
waiting
we have-
for one more speaker, Vijeta, sir, and then we can start in another 2-3 minutes.
So today I think we have 3 time zones represented, right? So John logging in from Singapore.
Yeah.
Great. And we have Amitji here from India. And Bian, you're logging in from USA?
I'm currently traveling in Indonesia right now. I'm in Bali. Yeah, we're incubating a few startups here. So
That's great because we were wondering otherwise the time difference would have been like absolutely atrocious.
yeah, no worries. It's not that bad.
Great. So Sayam, already?
Just waiting for Vijeta, sir, to join, and then we can start in another 2 minutes. He just confirmed me that I'll be joining in 1 minute.
Okay, fine. So while we are waiting to start, Sayam, maybe you could give a brief introduction of what the theme is about, and or is there? Or
And
do you,
he's already here. Yeah.
oh,
Yeah,
great,
he's already
wonderful.
here. Sir, Adi. Yeah. Thank you, sir, for joining.
Morning.
Good morning, sir. Good morning. So I think we should start. It's sharp 10:30. Thank you, sir, for coming. Thank you, everyone. Uh, I should start with the introduction first. Welcome back, everyone, on second day of Connect 2023 and Investor Summit. To begin with the panel discussion on the topic funding winter, not all doom and gloom. I would really like to thank introducing our esteemed speakers. I choose to go alphabetically. I would like to introduce Mr. Amit Singhal. He's a qualified chartered accountant with 18 plus years of experience across variety of industries. He is very active as a seed stage investor in startup ecosystem and launched Fluid Venture. He is an advisor board of various companies, incubators, and accelerator. He represented India as a part of delegation on various occasions. He is also a founder and director of ASR Business Advisory Private Limited. Thank you, sir, for coming on our for this particular session. Now, on next on the list, I would like to introduce Miss Bianli. She had a lot list of to be introduced, but since we have limited time, so I'll cut short her introduction. Miss Bianli is an award-winning thought leader, futuristic and educationist, and champion of building startup for sustainability. Long before COVID-19 accelerated the global shift in the direction, her work breathed life into the world-changing ideas at the intersection of technology, social innovation, and entrepreneurship. Bian founded the Hungry Lab to reshape, reimagine, and rebuild a better regenerative future in face of daunting global challenges. Founded in California, with presence across South and Southeast Asia, the Hungry Labs in an education, incubation, and research platform impact venture at Next Front Tech. She is 2019 Rex Karamveer Chakra Gold Karamveer Chakra winner and global fellow in India, and 2019 40 under 40 Orange County, California. Her work is frequently covered in media and medium. She is also popular podcast, radio, television guest, often contributed to academic books, publications, and trade reports. Welcome, Bian, for this session.
Thank you. It's a pleasure to be
Now,
here. Thank you.
thank you. So next, I would like to introduce Mr. John Lim, partner at Meet Venture, is experienced professional in startup and innovation sector. John has been invited to judge at various regional pitches, competitions, and speak at multiple conferences and elevator pitches in his country, Singapore, and abroad. He's also a keynote speaker at Yale NYUS China Summit 2019, Maritime Port Authority Singapore Innovation Summit 2019, QED Changemaker Forum 2022, and TEDx Newton 2022. John is also a member of Investment Committee of Indian Startup Seed Fund Scheme since 2022. Welcome, John, for this session. I would like to introduce Vijeta sir. 28 years of experience with leading organizations such as Taj Hotels, Metro Cash and Carry, Reliance Retail, Arvind Brands, NASCOM, TAI, Bangalore, and currently with Dexter Capital as an investment banking and merger acquisition and Dexter Angels, with a focus on working with VCs, family offices, angel investors to enable investments, funding in startups. Recent stint with being the executive director at TIA Bangalore and lead open innovation at NASCOM COE IOE. He is very strong in industry and investor connections and always ready to engage with folks in the innovation ecosystem. Thank you, sir, for coming. We are glad to all four of you on this our session. So going forward, we at AIC BIMTECH asked for each of you to participate in the session, and we are thrilled that you're here and you all come from various backgrounds, various regions, various investment theories, and various countries. However, one thing that entire ecosystem of startup is experiencing, and here a lot to talk about, what is this startup winter is all about. So my first question to you, Amit sir, and we have variety of audience here, new aspirants, students, experienced founders. Amit sir, my first question is, can you clarify the term to our naive audience, what this funding winter is all about? Is this something famous phrase from the Game of Thrones, winter is coming, or is something different when we talk about startup business? So our layman audience, please explain what is funding winter is all about.
No, the real meaning of the winter is the same as it's winter in the North India, where we stop working, we defer all the things. So in the startup ecosystem also the same thing happen, just like a winter. So these are the economic phase where after every up, down is definitely down will be there. So in the same way, in the startup funding as well, we have seen lots of funding in the financial year 21-22. So after that, this is a kind of correction where the investors have now decided that rather than just putting money, they want to wait and watch that who are doing what. So funding winter is nothing, but in a way it is a correction where the valuation have been dropped significantly and investors want to wait and watch before taking new bets on the startup. So that's how the startup funding winter should be taken by the entrepreneurs. So I believe it can be for 6 months, it can be for 9 months, it can be for 12 months. After each 2-3 years, we have seen such funding winters. Last time it came in 2016, where the funds were dried up and startups were not getting funding. But we have seen the back of this in 2017 to 2021, that how the funding have entered into the ecosystem. So yes, definitely I will not deny that it is a funding winter, but we have to take care that how to take it on our business. It may be different impact on all the businesses, but every business will have to see the impact on their business.
Thank you, sir, for explaining it very well to our participants over here. So follow-up question. So let us take some global perspective out here. So Joan, you are based out of Singapore, and my next question too is, you are running a consulting company based on Singapore, and you work with listed and non-listed companies for execution of their startup accelerator programs. However, do you think the funding winter scenario across the globe affecting the businesses, and could you highlight the scenario in your country as well? So we want to understand how does Singapore, maybe you are grappling with something like this, or is it everything is okay in your country? I'm sure there are a lot of talk around this as well in your country.
Yeah, thanks for the question. So recently I read an article by Enterprise Singapore, which is a government agency in Singapore, and they released this statistics, which is I think in 2022, investments up to Series B in Singapore, there was about 5.5 billion. And that's an increase by, I think, 45% in terms of value. So that I think from that alone, you can tell that for the earlier stages up to Series B, there is still quite a bit of funding liquidity. But from Series C onwards, there's been a 25% fall in funding value. That's in 2022. So I think the way I look at it is that we can look at funding in two segments. The earlier stages before Series B, A, B, and C, and C and beyond. I think for C and beyond, which is where most of the unicorns and the larger companies of the world, they tend to be at, probably they might be facing a bit of a crunch. But in this part of the world, I think in Singapore, Southeast Asia, most of the startups are generally at the earlier stages. And because of that, I think there's still quite a bit of liquidity. Yeah.
Okay. So since you talk about a later stage funding, Series B and C, and so I would like to ask Vijeta sir, the very next question is, sir, you have a wealth of experience in variety of profession, and the overall experience has touched practically all the industries. What has changed in past 1 year when it comes to investment, valuation? We have been listening this term, valuation bubble, funding in venture capital ecosystem. How do you take on this entire ecosystem when it comes to later stage funding?
Sure. So let's break this up into three aspects. Okay. So one, there is the VCs and family offices that are putting in money for the equity portions. Then there's definitely a lot of activities around M&A in both the traditional as well as non-traditional, and both buy and sell. What I mean by that is there are mandates coming from large enterprises and family office where they're saying that these are the kind of startups that we're looking for to acquire or take a significant stake with. Okay. And then in terms of even debt funding, right? It's not being frowned upon right now. And in fact, from Singapore itself, there are so many big players are there, like the Mars Group, etc., where they do large ticket venture debt. And they're doing it at a much better rates than you can ever imagine. And plus, you also have revenue-based finance, etc., etc. So the options that are there for the startups to actually garner working capital or funds, etc., has become much, much more. Well, we do know that let's not run away from the fact that yes, there is a slowdown. Early stage, not so much, but in the later stage, what's happening is there is a lot of pushback on valuation. So that means things are slowing down in terms of they saying like, you're not worth so much, your runaway is less, your numbers don't justify it. So these kind of conversations are going on. We as an investment bank and an M&A in terms of Dexter Capital, we are still getting a lot of inbound business. In fact, we say no to more people than yes. And from the angel investment part, I think, Amit, you also know that we have been continuing to invest. So in the last 3 years, our check sizes have increased. And touchwood, we have been able to raise a lot of money, Sanyam, for the existing portfolio companies that we have. We have put in, say, a couple of crores. But now we're able to raise, like 5 crores, 10 crores for them, quite a few of them. And most of these is public announcements. So having said that, I would not say it's a changes, and it's something that we should all be very, very alert towards, that ultimately from the investor point of view, what do we want, right? We want to make sure that for the people who are trusting us and backing us up, we're making a reasonably good return. So it's as fundamental as that. So for that, we don't stop talking to other investors. We don't stop talking to accelerators, incubators. In fact, Sanyam, if you guys have got some phenomenal startups who are looking to, grow to the next level,
yeah,
more than happy to be talking to them, my friend. Okay.
Definitely. So I'll come back to you again on M&As and more funding into the ecosystem. So Bian, hey, hi, thank you for coming. And so I want to understand, since you travel across different countries, and right now you are based on the USA. I saw that you also belong to Southeast Asia as well. So South Asia, I think somewhere you met Joan as well, maybe. So want to understand the global perspective, how the entire globe, how West take this entire thing when it comes to funding winter investments and investments specifically into the different part of the country, even if it is India or maybe another country. So can we understand the global perspective of this entire scenario that is we are facing across?
Yeah, so like, the theme of the topic, it's not all doom and gloom. And it is a good time actually now for several things. One is to take a step back and really reflect on the why it's happening and the dynamics. So it's a good opportunity now for investors that are holding these startups feet to the fire. And as the previous speaker mentioned, Mr. Shastri, about the valuations of actually are these valuations supposed to be what they are. Second thing, it is a great opportunity to look at the nuances and the directions within the overall landscape of where the funds are flowing and where they're flowing out of and where they're flowing into. What we have seen, and our focus has been on really accelerating startups and emerging tech for UN Sustainable Development Goals. We have seen a huge influx in capital into ESG. So we work with a lot of corporates, a lot of corporate investment funds, corporate innovation funds, government multinational innovation funds. Pretty much 9 out of the 10 inquiries that we're getting has been focused on some type of ESG. And so that is really crucial. So we're seeing an uptick on that. That is actually increased when other things that have been hyperinflated, overinflated in the past, like, crypto, fintech, have sort of calmed down. And so it really is an opportunity to reassess. And a lot of our startups, we advise them to expand their net in terms of looking for funding opportunities, because just because you are having one type of product in one industry, have you considered that your product can actually be applied towards other things that are in other industries that are receiving funding? So broadening that net. And we're actually teaching a course right now with our startups that I'd like to share some advice from. And I like to say, when funding is lean, it's time to get fat. And FAT is an acronym. And it's 3 things. So F for fundamentals, right? Really getting into growing a business, right? The unit economics, back to basics, focusing on internally improving efficiencies. A is for alternatives. Alternative funding is really huge right now. Innovation funding, grant funding, debt financing, revenue-based financing. So there's a lot of other opportunities there. And again, a lot of like the debt financing and those types of things, you need to go back to actually building your business that are your basic sound. What we're seeing is actually now, and we're working with a number of various organizations that are trying to merge a hybrid grant funding with VC long-term equity investment. So there's a lot of new innovations coming out, and I really advise a lot of startups to really broaden their search and broaden their net. And the third T is for traction, and that is related to going back to the basics, really growing organically, growing your customers, really focusing on investing in your core technology, your core product, your cash cow, if you will, versus a lot more exploratory, excess funding going towards exploratory research and other things to really get you through, get your working capital through those lean times. So that is something that we have found that really is helping startups, no matter where they're from. And one of the reasons why I'm in Indonesia is actually there's an influx of capital for a lot of the ESG programs that we're involved in related to startups. So especially related to climate. So certain sectors are seeing an uptick. When funding is lean, it's time to get fat. And I'm happy to share. We have a primer on that. If anyone wants to email me afterwards, I'm happy to email that to you for further information. Yeah.
Definitely, Bian. And we can keep this conversation as on. Thank you for sharing that global perspective. And obviously you talk about the ESGs as well. But one thing important that you just mentioned, back to basics and understanding the basic thing, which actually takes me to the next question. From past few years, we kept on talking about one term, which is valuation, right? Startup founders were chasing valuations rather than value. But Certainly, I've seen a lot of startups talk about value as well. In fact, in the VC ecosystem or maybe angel investing as well, where this is most talk about. Amit sir, I would like to ask this question to you. How do you take on that when valuations get corrected, and now when it comes to investing, are we shifting towards value rather than only looking at the fatty valuations?
So this is a fundamental rule. Whenever you have a surplus fund in your bank, you will try to gauge the growth in your company. So you will always run after the growth, irrespective whether the profitability is there, sustainability is there, whether your customers are ready to take your product or not. You never bother to focus on that. And whenever you have a scarcity of funds, you will always focus that how your customer can become your fund financer in a way. Means ultimately your dependence is now only on your customers. So take with an example, if you are earning 100 rupees and you are earning 200 rupees and there is a fund manager who is financing that 100 rupees, you will never bother whether I am EBITDA positive or not. You will always think that how I can add more customer, and sooner or later I will earn that money from those customers. And whenever the funding will be dried up, then your focus will shift towards your revenue portion, that how I can earn from this set of customer which are already with me. So that's way it is always better this kind of situation where startups start focusing on their revenue as well. It is not always necessary that they should come profitable very fast, but at least they start looking at path to profitability, that in case they have only 4-5 months runway or 1 year runway, they start thinking about that. So rather than thinking about the valuation only, which is depending somehow on the top line sometimes, because we always talk like that, okay, in SaaS you are getting 25x of the top line. No one talk about that in case there is 5 company who is doing better out of which everyone valued at the same terms. But whenever there is a funding winter, we all start evaluating other portion of the business as well. So that's how it is important that we should look at other parameters as well, not only the growth parameters. So it is good that worldwide now we have start talking about the sustainability, we are start talking about the profitability, we are start talking about other parameters as well.
So do you think that, continue with this question as well, do you think that the way we were evaluating startups earlier, the entire parameter has to be changed, and we should also standardize few things? You are a CA, you understand in and out, how the traditional accounting happens, and ultimately it's the profits that matter when it comes to traditional way of, in fact, for the listing companies as on the stock market. Do you think we should also talk about the standardization of the valuation as well, rather than only talking about GMV and other parameters while doing a valuation? So what's your
as I
views on
mentioned, definitely apart from the top line, there should be other parameter as well to judge the valuation. But I personally feel, and other panelists may have a different opinion, but there can't be a standardized formula for the valuation at all, because we have seen many cases where the similar startup which have been started from US, they are getting a valuation of 10x which we are expecting in India, or it may be China, in other part of the world. So there may not be the standardized formula, but definitely there should be much more parameters rather than only having top line parameter or the growth parameter, whether this company is growing 10% or 20%. There should be other parameters as well, that how fast this company is going to be profitable, how large is the market size where they can really be there, even if they will increase the price by 5-10%, or whether they will be sustainable or not. So there should be 10 other parameters which now fund manager have started evaluating. Means for the last 9 months I am seeing that days have been gone where people were only asking about the GMV or top line. If we will go back to 2015, no one was aware that what is the top line. Everyone was talking only about the GMV. Now the GMV word has been eliminated from the funding part. At least now people have started talking that eliminate all the taxes or eliminate all the discounts, etc., and only talk about the top line terms rather than telling us that what is your GMV. So at least we are evolving, and sooner or later we will start evaluating other parameters as well, which are very important for the valuation.
Sure, thank you. John, so I'll just take a different tangent from here. So we talked about valuation, funding, and we do now understand what this funding winter is, well explained by Vijeta sir and Amit sir. So, John, I was reading some statistics. This is regarding layoffs, and that is happening. That's a recent phenomenon. And in your country, we know that Google, Facebook, Amazon, the big companies also doing it. But well-known startups in your country, John, just to highlight, in your country, I've read there's a company C Limited /10% of the entire staff. Client laid off 18% of their workforce, and many other technology companies that are engaging in layoffs. In our nation as well, we keep on witnessing such. What do you think that could be the reason? Is it that overspending on the hiring, or is it that entrepreneurs' inability to understand, what should be the right number, considering the future maybe demand or something else? So can you please explain, or maybe it could be the technological shift that we are right now talking about, automation, AI and everything. So what's your take on that?
Yeah, I think it's interesting you mentioned the company C. So they fired about 7,000 people last year. And they were not the only ones. I think there were quite a number of other companies that also laid off a significant number of their staff in Singapore and around the world. But the interesting thing is that the same company that you mentioned, C, they just made an announcement very recently. I think it was just last week or something like that, that they are intending to create 2,000 jobs. So they laid off 7,000 last year, and this year they are going to hire 2,000 more. But sadly speaking, they are not going to hire the 2,000 in Singapore. They are going to hire them in Malaysia. So I guess one factor that is also probably the cost of hiring in Singapore is higher. So I think this is something that we are seeing. I think companies shifting their headquarters and their regional headquarters to locations where the cost might be a bit more friendly to them. And as to the question about why are they doing this, I think maybe one reason could be because of the funding crunch as well. Like I mentioned previously, I think when you are Series C and beyond, especially if you are at a unicorn stage, funding becomes more and more scarce. And I think that's the reason why they are also tightening their belts. Okay, if you look at the share price of Shopee, of C, if I'm not wrong, it has also fallen by a very significant percentage. If I'm not wrong, it's dropped by about 70-80%. So that could be another contributing factor.
Thank you, John, for sharing the insights. So you talk about funding. This brings me to the question to Vijay sir. And since you also touched upon the technology part of it, Vijay sir, there's a recent phenomenon when it's a lot of talk about AI, right? And I was thinking, all of you as an investment companies invest in variety of companies. And since AI is something that we cannot go away with, it has to be embedded into the core of the entire company. Do you think that your existing portfolio might also see some kind of consolidation when your existing companies which you have invested in will go away with the business just because they're not able to innovate, or maybe some kind of companies which already you have invested will merge into the single line of business just because of the technological thing that is happening? So are you also as a company, as a capital firm, looking forward towards that as well, or are you talking with your founders as well?
So see, very critical for all of us to continue to be students and researchers, as they say, in this business. Hundreds of years back also, if you remember, whether it is the auto revolution or the garment revolution, it has all happened because a new technology came in, which made a disruption and brought the cost down. And it also helped whichever company there was to reach to a larger and wider audience. So it's the same history lessons that we have to remember and learn, whether it is AI or whether it is ML or it is whatever the blockchain. And these are just technologies, Sanyam. So what really matters is ultimately it's the ability of the execution of the founders and their team that really makes a big difference. And that is what we look at. First, we always look at the founders, number one. Number two, when we do a due diligence, right? And I'm sure this is something that resonates with all the other investors here. When we do the due diligence, there's also an operational due diligence. There is obviously a due diligence on the founders, especially now with all the headlines that are slamming our, about integrity and the shortcuts that people are taking. We'll do a financial due diligence. And yes, we will also do a tech due diligence, okay? And now in tech due diligence, we'll also understand like how exactly are the founders or the teams going to use the technology to ramp up. That is to make money, more money. They bring down the cost of customer acquisition. They bring down the cost of actually going to market much more significantly. And can they enable using technology, they're going to get more and more customers. So that's a fundamental. It's not just about the technology, it's about ability to execute. And that is the most critical thing. You can put all your fancy terms, you can put all these fancy names and buy lots of softwares and everything. But if you don't know how to use it, it will not work out. Okay. And then let me also clarify here, and because Amit is here and he's from the DNO, they focus on D2C as well, right?
Yeah.
A lot of D2C companies that we are working with, whether it's on IB, M&A, or as Dexter Angels in the early stage, they are very smart people who are learning how to use the technology to up the game, make more customers, better
that's true.
branding, better packaging, etc., etc. So just answer your question. It's not about the technology alone. It's about the ability to use it well and to execute. And I think this is something that John and Bian also would maybe like to put in some thoughts. Yeah, thanks.
Yes, definitely. So I'll come to Bian next before. So I have a follow-up question. So why these M&As are happening? Is it because the technology consolidation is happening, or is it a funding consolidation happening? Because I do understand you just touched upon the due diligence thing, when a single backed VC company having multiple investment into the similar kind of companies. So why this M&A we are witnessing so much, especially the last year, when we talk about the big names? Vijita sir, just this is for you before I actually go to Bian for the next question.
Okay, sure. So I tell you about M&A, right? This is an opportunity, right? And it is not against the founder also. Please, I want to be very clear on this. So why are founders and the startup, some of them, even those who are SMEs or they've been around as family businesses for some time, they believe that they can't scale beyond this certain point. Number one. Number two, succession is always a problem. So they might have been running this company for 10 years or 15 years, but the next generation is not ready. Or they believe that they can do something else. Okay. And that's why they come up to the M&A market, they approach us. That's number one. Number two is why, and other way around also, why are enterprises approaching us? And approaching, not just when I say us means the investment bankers or other people who facilitate all these things, because we are well connected to the ecosystem. They also believe that instead of going out and building everything organically and using greenfield ventures, maybe they can actually capture the technology, the founders, the expertise, and the markets and the customer intelligence that is already existing within some of these companies.
Right.
That is why they're talking to us, and it has to be a fair evaluation. Okay, so it is, I believe, a very strong win-win. And yes, there is a challenge that if you see some, even in India, I will just talk about India's scenario right now also. There is, whether it's Reliance or the Adani Group, who's in the headlines for many reasons, but if you see Aditya Birla Group, Aditya Birla does a lot of D2C, right? They've been buying a lot of fashion apparel.
Yeah.
A lot of these new age people like Menza and Goat, which are doing fashion and D2C, etc. Then if you see technology companies, artificial intelligence companies, the large Tatas has bought 1mg, they bought into, like the fitness groups, etc., etc. So there is a reason why. You'll also continue seeing this kind of consolidation. And look, let's say it's a good thing, right? Technology is getting dissipated, number one. Number two, employment is being conserved, because especially in a large country like India, where we still have a lot of socio-economic stress, making sure that employment is there and the country is surviving, GST, tax collections are good, are critical. So M&A is very good. We are talking to a lot of large players in countries like the USA and of course, even in Singapore, that how can we also showcase that this is our portfolio. And then we also want to understand what is the, some of the mandates that these large companies have, so that we can hunt within our networks and find it, right? Because we have ISBs and ISBs and IMs, we will find people. So I hope I could answer your question.
Sure, sir. I think you very well have given the positive aspect of M&As, and yes, I agree to part of it. Ben, hi. So I was reading your profile, when you shared, and I haven't mentioned in the introduction as well purposefully. You were running a leadership series, which names is, and it's a trademark, Startup to Save the World. Can you please explain how you do this and what is the purpose behind? And if you can explain to our audience as well.
Oh yeah, so we started it in LA in 2017, and it's a global innovation roundtable series. We did it live, and then during COVID we moved it online. But basically going from in various cities where we work with our startups around the world, starting in LA, in California, and choosing one UN Sustainable Development Goal for that particular event, and then convening the various stakeholders within the local ecosystem, the startup founders, the investors, the policymakers, the NGOs, the various change makers and stakeholders that are working on solutions, and really bringing everybody into a room, a place where big ideas are born, and getting them talking and breaking out of their silos. Because what we found is a lot of startups, they have a very narrow view of where they can get funding, where they can get partnerships, where they can get their users. And so it's helping broaden their perspective. And also to educate, we invite the public also to come. We had a lot of great events where in public attendance, especially in Mumbai, and that we focused on EdTech in Mumbai. In Chennai, we focused on AgTech, Singapore, water tech, and so we have in Indonesia, climate tech. So there is a number of, it's really important to bring everyone together. And second of all is this is the inevitable trend. When we talk about sustainability, when we talk about ESG and impact investing, it's not just a niche investing trend right now. It is inevitable. And especially when we go beyond just the end user application of technology to actually the business models themselves in terms of the sustainability of the business models. And so what we say is actually, we're building a regenerative future. And what does that mean? Well, in the past, everyone was talking about building resilience, and resilience is not enough when we're looking at how do you evolve to a very rapidly changing future. And startups are a big part of driving that conversation. And so, there are three types. I say, right now the RRR movie in India is very famous, right? Just won the Golden Globe for the best song, Naatu Naatu, and nominated for an Oscar. And I say, in startup world, there are 3 R's as well. There are 3 types of founders, 3 types of mindset that basically beget 3 types of startups. And there's one of them that will really be able to not just weather the funding winter, but also overcome it and thrive. And there's 3 R's. The first one is the reactive startup, right? The founder. The second is the resilient founder and startup. The third is the regenerative founder and startup. And so when we look at the reactive, there's a lot of the copycats, the startups, or the ones that are just going with the flow and just doing and reacting to every single market dynamic, right? Not really having a lot of foresight or not a lot of strategic planning and being able to see the larger, pictures beyond each quarter or, each month and the very minute minutia of running your startup. So they get left behind. The second is resilient, and resilient is a step above. It's better because every time you get knocked down, you get up again, right? But that ultimately still beholds you to the current system, right? You are still, constrained within the confines of your industry, confines of the larger dynamics, and you are still less in control, right? You can you respond better, but you're less in control. So now when we look at the regenerative founder with the regenerative mindset and regenerative business, what does that mean? It means that in the face of all of this overwhelming uncertainty, the military acronym VUCA, right? Volatile, uncertain, complex, ambiguous, right? The future is only going to be more and more VUCA. It is, so how do you take, such challenges and reinvent and regenerate not just your business model, going from just a product to a platform to a network, but also establishing greater partnerships, establishing greater stickiness, if you will, of all the stakeholders in your ecosystem to generate multiple value streams, not just a linear flow of supplier, product, customer, right? And how do you then apply that towards regenerating, in terms of what now is an inevitable, which is ESG, sustainability, circular economy. And so that is what we have seen the difference between startups that are able to survive, weather the storm, and thrive. And so those are what we have found is the differentiating factors between various startups and startup founders.
Thank you, Abhiyan. I think this is a wonderful explanation of RRR you just mentioned, and we'll definitely have a conversation around this theory. And thank you for sharing that. Amit sir, my last question to you, and then I'll have a single question for everyone. So, real-time angel fund that you also are part of it, and despite so much of funding crunch, how do you and since you are very positive when it comes to angel investing, what makes you do that? And secondly, what is despite since this is all over the news, startups are losing money, and you also reach out to certain LPs who want to invest into the startups. Do you also see such kind of resistance from the people who are new to investment, or are they taking risk for investing in early stage startups? How things are happening on the ground?
Yeah, sure. So this is a very good question. To be very honest, this is the basic thesis of any kind of investment. It is not only for the startup. It is applicable on the stock market. In case you are investing in gold or any asset class, you will have to follow the thesis that where the market are negative, you will have to enter into the market, and where the markets are positive, you will have to exit from the market. So in case you will follow that rule, you will always make money. You will have to go opposite the wind. Otherwise, you will never be able to earn what you want to earn. So the same fund are applicable on startups as well. So whenever people start saying that the funding winter is happening, we went aggressive in investing, because now it's time where the valuations have been corrected and you are getting the right valuation from the market. So that's how we increase our investment, and we did a very good investment in last 6 months, and from both the fund, it applicable on Fluid Venture as well, which is D2C focused late stage fund, and real-time angel fund, which is investing in early stage. So I follow the same theory, and I explain the same thing to the other investors as well, and they understand that, because definitely they are new to the startup ecosystem, but they are already an investor in other asset class, so they understand the theory of entry and exit. So we didn't get any resistance, and you can see that we are investing almost one startup every week. So we are going a little aggressive in this scenario, and we will slow down whenever we will get out of this funding winter. Then we will start working on our portfolio management, that how to make sure that things are in right direction. But to all the investor, I suggest that this is the right time to enter into the startup ecosystem. So nothing can be better than this time.
Great, sir. Sir, for our audience as well, we will take question and answers in last 5 minutes of this. So if anything you want to say, just type in chat box on Q&A. So we will take up in the last 5 minutes. So one question for everyone. To start with, maybe John, from you, where are we moving towards? When you are investing into the startups, where this entire startup ecosystem future is going towards, and portfolio disclosure 10 years away from here, down the line. What do you think that the most significant sectors that will come out and you want to restructure or make your portfolio? John.
Yeah, thanks for the question. So far, at Me Ventures, we have been investing out of our balance sheets. We have a couple of early stage investments. Moving forward, we'll be starting a new fund very soon in Singapore. And I think with regards to where we'll be focusing, if you look at statistics, right, globally, there's about 1,000 over unicorns. And majority of them are in US, 600 over. And in China, you have about close to 200 of them. And then after that, if you look at this part of the world, which is in Asia, the next largest market where all the unicorns are concentrated is actually in India, where you have about 70 plus, right? And this is the data that we got, after checking out from CB Insights, list of all the unicorns. Yeah. And if you look at Southeast Asia, where I'm based, if you look at Singapore itself, there's 12 unicorns, and the rest of the Southeast Asia put together, there's only 27. So I guess for us, geographically speaking, the two key areas that we will be looking at moving forward will be India and Southeast Asia. Together, I think we'll be able to spot at least a couple, hopefully, of the next 100 unicorns in this region.
Yeah.
And I think in terms of sectors, I think at the moment right now, we have been hearing a lot of interest in the sustainability space. But I think one thing to take note is that I think unicorns can come from any sector. And that's why personally, for myself and my partners, we are sector agnostic. We don't really focus so much on which sector we are from. What we look at instead is the quality of the founders, because good quality founders will be able to make good decisions that will drive their companies forward. So I guess these are some of the insights that probably I'll be able to share.
Yeah, thank you, John. So before I move to next panelist, so one wow thing that you think that Singapore has, which attracts investors. So if you would like to share one wow thing, if it can be policy as well, it could be other things as well. So if you can highlight one thing.
Yeah. So I think a very little known fact is that in Singapore, there are about 900 over VCs. So there's a lot of VCs coming to Singapore, and I'm sure there's a reason why. 1 year ago, I actually invested in an Indian startup founder. But it's very interesting because their company is headquartered in Singapore. And I think one reason why many funds are setting up in Singapore is because of this particular reason, which is because of the money, and probably that's due to the legal structure of funds, etc. Maybe it might be more, there's more tax incentive if, let's say, they were to set up a fund in Singapore rather than their home countries. And the money is parked in Singapore. And that's why we find that there are actually many startups that are actually coming to Singapore to seek funding. And this becomes a good fishing ground for startups then. And that was also how I managed to identify some of them. If you look at Singapore is a very small country. We have a population of about 5 million. But if you look at the number of unicorns, we have 12. In Malaysia, you have, I think, 2. Indonesia is so big, they have 7 unicorns. And Philippines, Vietnam, Thailand, they each have 2 unicorns each. So how does a small country attract or have so many unicorns, 12 unicorns? Actually, the answer is very simple. Most of these unicorns did not originate from Singapore. Most of these unicorns, their founders are actually from overseas. But eventually, after they grew to a certain size, they came to Singapore to raise funds. And because of that, they decided to set up the HQ here. And that's how we managed to add them into our team. But I think a note for investors in this aspect as well is that smart and good startup founders, they are mobile. And because of that, they will usually go to places where the money is. And I think that's also the same for, if you look at the US. Why are they able to attract so many quality founders, right, to the US through their programs like Y Combinator, etc.? It's because the money is there. And the smart good companies, even from Singapore, they are going over to the US to raise funds, to start their businesses. And good for the US investors because that becomes a fishing ground, easy for them to pick up the best ones. So I guess that's probably my 2 cents.
Yeah, I couldn't agree more with you on this, John. So the same question, Vijeta sir, how in the 10 years down the line, what sectors do you think that going to be win-win, and how you're restructuring your portfolio for the future? I think you're on mute, sir.
Sure. So I think structuring the portfolio, see, we have not touched things like crypto or Web3, drones or EV yet, because it's not just whether there's opportunity or not. It's also for us, we focus on the policy regulations. Okay, so we have to be very cautious that when we back someone and then suddenly the policy changes, everyone gets affected, right? Employees, the founders themselves, the people who have backed us, the investors who trusted us, etc., etc., and our own money, because we put in our own money as well. Only then do we take it forward to the rest of the world. So we're careful about that. But having said that, and look, I know there's a lot of talk about flipping. There's in fact, tomorrow I'm going for a budget conversation which talks about that, right? We are going, we're bringing all big startups and VCs and everyone together. Where only conversation is what is going to happen, the new structuring, RBI guidelines, what's going to happen for startups, for entrepreneurs. We have heard about what happened to PhonePe, right? Which was the reverse. They came to India and now they've got a tax bill of, I think, $1 billion.
It's around 8,000 crore. Yeah,
8,000 crores. It's a massive. That's huge
Yeah.
money. If the government recovers that, they'll be so happy, and it's but then, so it really depends, right? So I don't want to comment much on policy or what is going to happen, but I think what matters here is that how closely can we all work together, how can we integrate together, and also one of the things is, I'm part of a lot of these industry associations like BCIC, TIE Bangalore. I used to work with NASCOM, and we work with the Center of Excellence, everything. So what we say here is, how can we influence a little bit of policy? Right? Where can we say things that will make a big difference to bring in? One is, we want quality capital to come in from places like USA and Singapore and other places. We're even talking to a lot of family offices in Malaysia and Indonesia, and they're putting in money to our companies. There is a lot of opportunity for many of our startups and portfolio companies to go to the other countries, because they'll get great access to more capital. They'll get access to talent. They'll get access to new customers. Ultimately, customer money is such a good thing.
Yeah.
So if it means that restructuring can be done, and look, I'm also this is for John and Bian, happy to stay connected and get to understand your viewpoints, your theses, and if there are any white papers you have published on how best this can be done, we are more than happy to take our portfolio companies in front of you, because I'll tell you why. See, one thing that we do is, for example, in India, SaaS is very big, right? So many of the SaaS companies, it's very clear that you must get customers from the US. Because they pay you in dollars, they pay you on time, they're bigger customers, the stickiness factor is much, much more. At the same time, we understand that Singapore, as you said, has got fantastic setup of family offices. In the US, you have got brilliant, whatever you want to call it, accelerators like Y Combinator. You yourself are there at Hungry Lab, and there are so many others. Techstars is there, whom we work with very closely. So what are the ways that we can help our founders? How can we get in fresh capital? And if it means that we have to understand legally how restructuring has to be done, what are the ways that we have to, change a few aspects here and there, we are the most happy to learn and work on this. Thanks, Anyam.
Definitely. And we also want to contribute a bit if we get a chance to do that.
Absolutely.
Right. So my question, the same question, Bian, to you. So how do you see, and I think this is the same question by one of our participant as well over here, is Sahil Banod. What are the top 3 future trends do you see that is coming, and how you are taking this, and if we talk about next 5 or 10 years?
Okay, so our rethink tank, the Hungry Lab rethink tank, which is our insights and research arm of the organization, has been doing a lot of studies and interviewing and working with a lot of fund managers and innovation funds and VCs. And one of the things, there's 2 things that we're looking at from the research has come in, and I'll be happy to share the report when it's out in the coming weeks. Is one, everyone is talking about ChatGPT and all of this stuff, and I just want to say that the tech doesn't matter. The tech, insert blank, whatever tech, ChatGPT today, whatever it is tomorrow, the tech is always going to be evolving, right? So if you're continuing to chase the tech, you're playing a losing game. So so we know that tech is going to continue to be evolving. So we shouldn't be investing in seeking funding for the tech. It should be, what we're seeing actually now is two changes. One is in the US, we use a very folksy saying. We say a come to Jesus moment for the VC industry, right? Meaning it's a dead reckoning of what the future of VC is, what it should be, and why is it the way it is, right? Why are we accepting a 90% failure rate when in so many other industries that would be catastrophic, right? Why can we actually come up with something better? And that is a whole nother Pandora's box in and of itself of a conversation to have, right? But we're starting to see that conversation being had in many different places, right? Why is the measure of success of a startup a unicorn, right? We work with a unicorn, Theranos was a unicorn. So many of these big, disasters were unicorns. Yes, there is something to be said about, that lifting up, but funding, so many times people startup founders fall into the trap of thinking that the metric of the success of a business is funding, right? And so that mindset needs to be fundamentally changed and shifted, right? Because that is not sustainable. And we're working with what we're seeing, what I'm very encouraged by is the number of second generation, third generation family offices that are coming to us. We're in these conversations and they're saying, how can we create a new, for example, an ESG 2.0 platform? How can we create something new and not just chasing after the latest technology that's going to be obsolete in the next 2 years, right? And so the innovation in terms of changing the conversation of the purpose of VC and how it's going to be carried out in the future and what it means for fundamentally to be a successful startup, right? And second, and we're with the unicorns, we're actually seeing a growth of what they call zebras, right? The hybrid startup companies that are achieving high valuations, not at the exponential rate that a unicorn would be, but that are growing fast, that are focusing on the triple bottom line, people, planet, profit, right? And then we're also seeing a reconfiguration and a realignment of business models themselves, right? When the tech itself can be replaced every 2-3 years, every year, right? With the latest fancy thing, it comes down to how are we innovating the intrinsic business models, right, of the startup and innovating the value-driven ecosystem that supports it,
right,
to strengthen those connections, strengthen those partnerships, strengthen those force multipliers, and accelerate and create value based on the regenerative business models versus simply just chasing after the next trend, right? And so those are a lot of those conversations that we're having with various different organizations, which is very, very encouraging. And what we're seeing as that trend, it's not going to happen overnight. A lot of it requires mindset changes, ego changes, right? And a lot of those things that comes down to the acceptance of a new reality in this increasingly VUCA world. So not to get too philosophical, but it is really important that we think about the ultimate purpose of why do we do what we do, and how do we get to this next evolution.
Yeah, and thank you. I think we are also short of time as well, and it's just 5-7 minutes more. Amit sir, so it's the same question to you. So where do you see that in next 10 years, trend is going towards, and what are the fifth sector you think that is must have in your portfolio?
Sure. So second part is easier for me because apart from D2C space, which is consumer good, which is my full-time focus. So apart from it, I'm personally very bullish on 3 sectors largely, and I'm planning to invest in this sector. First one is health tech, where I'm very bullish as of late. Clean energy is another sector where I'm looking for it, something related to hydrogen and other clean energy on which the government is also very focused. Apart from it, I am very bullish on the creator economy as well.
Creator.
Feel that, and it is some way related to my D2C space as well. And I'm evaluating various startups which are coming into the space and are doing very well. Other thing like Web 3.0, definitely a favorite areas of mine, and I feel that will be the future. It doesn't relate it to cryptocurrency, but something related to metaverse and other stuff. I'm bullish on that. So
thank you, sir.
Areas where I think that they will perform very well in next few years.
Yes, thank you, sir. Thank you. I think that is the clear trend that we are going towards, and government is also pushing so hard when it comes to clean energy. Health tech is about to happen, and we are also witnessing certain startups which we have never used to when we start our cohort. Thank you, sir. So before I start with a closing remark, I want smiling faces, and so that we can get a good picture for posting on social media. Himanshu, can you please do needful?
Yes. Smile. Yeah, thank you.
Thank you, Himanshu. Thank you for here. Himanshu was my supporting over here, and Mrunal and Ava ma'am is already here. So with the closing remark, I thank you, dear speakers, for your valuable insight and making this time fruitful for everyone who is listening. You all have highlighted important points that can be useful for audience when it comes to future trend as well, so that our audience can always look forward, especially if there is any student out here and they are planning to do some certain kind of startup, they can think of in that certain areas which our speakers highlighted. And I'm hoping that the session would be provided its listeners with useful nuggets of information, and they will be inculcating here forward. Again, I like to thank everyone out here, Amit sir, Bian, Joan, Vijeta sir, for giving your valuable time. And I would also like to extend my thanks to our host institution, which is Birla Institute of Management and Technology, BIMTECH, and our partner institute for this session, Manav Rachna University, IIMT College of Polytechnic and Indore Institute of Science and Technology. Thank you for your time. And that's it. Ma'am, would you like to, we still have 2 minutes. Would you like to do, say to the speaker?
No, I'll just say thank you. I mean, I know coming in at different time zones and scheduling everything. So thank you, all of you. I mean, John, Amit ji, Bian, Vijeta ji, thank you so much. I mean, it's a pleasure always having you on panel discussions and listening to your insights. I will love the way you had actually handled things, because it's important. I mean, people think that we have a funding winter, but the way India is going, I mean, sometimes you really have to think about it. So, I mean, across the globe, we are seeing certain symptoms. But I guess, John, Bian, this is just symptoms which are going to cleanse out the system, right?
Yeah, right. Yeah, I spend about 6 months out of the year in India. And so there's actually a lot of things that are very exciting coming up, especially in the clean energy space. We are incubating a number of various climate tech startups in India. And there, the regulations have become actually very favorable, especially towards solar, making it more affordable. So there's a lot of things, great things that are happening. So accelerating progress in the right direction.
Thank you. Thank you.
Yeah, and before you, everybody, the audience attendees, this is the same link where we are starting a startup pitching today. We'll be starting at 11:45. If you want to stay back as our audience, you can stay back and rest can be. Thank you. Thank you, everyone.
Okay, thank you.
Thank you so much.
Thank
you.
Bye-bye.
Bye.
Bye-bye.
Thank you.